Hey, Sean.
Hey, how are you, Andy?
Good. Just reading about Newmont Mining diluting themselves with a stock offering from J.P. Morgan. Can
Talk
you
about
imagine they're using J.P. Morgan?
yeah,
That's how screwed the industry is.
talk about sleeping with the enemy.
Yeah.
Hey, friends, welcome back. Thanks so much for joining us. I have back on the line our good friend Andy Hoffman from Miles Franklin to talk about all things economy and precious metals manipulation. Andy, welcome back.
Always a pleasure, Sean.
Hey, always a pleasure. It's great to do these every 3-week updates because things are changing so fast as you and I document the collapse that it's literally impossible to keep up. But I do want to start with this one. I think it's fairly big news, and I know you referenced it recently. It's an article from Avery Goodman over at Seeking Alpha, and the title of it is, Did Comex Just Receive a Physical Gold Bailout from the Feds? And it's pretty gripping. He says, in an article dated June 1st, 2015, I pointed out that Comex clearing members had gotten themselves to the edge of a widespread default on physical gold delivery obligations. They faced net claims of 550,000 troy ounces against only 370,000 registered ounces left at the Comex warehouses. That left a deficiency of 170,000 ounces or 5.29 tons of gold. And who stepped in to save the day? None other than J.P. Morgan. It's just such an important article, and it's such important documentation of the collapse. Andy, what do you make of that article?
Oh, look, I mean, it's par for the course. I mean, let's face it. I wrote an article last week called Comexident, meaning like Grexident, as they're talking about in Greece, where something, no matter how much everyone believes that the Comex is all powerful, it's basically a U.S. government entity. At some point, something is going to break its grip on the gold price, and it may be an accident. Maybe someone screws up, or maybe just as a big buyer comes in and takes them out, or they just they show their hand too much, or maybe they're just rendered irrelevant by the movement of gold overseas, gold trading overseas, so that we won't have 99% of the major price movements in gold occurring between 8:20 and 10 a.m. Eastern Standard Time. But in this particular case, I believe this was the first time ever that as we closed a contract in June, that there was actually less gold in the registered inventory than was claimed by the delivery notices. Now, of course, the delivery notices often magically disappear, probably by cash settlement, which is illegal. But the fact is, we're showing basically an all-time low level of inventory, which is worth no more than like $450 million. That's it. That's the whole registered inventory on the Comex. And more people are calling for delivery. So look, there's a very fine line when you have this tight supply and demand worldwide is rising. And in this particular case, this Avery Goodman, and kudos to him. I think we have someone just joined our team who's intelligent and understands how things work. He's basically saying that it looks very much like a swap came in, probably from the Feds through their various swapping and lending schemes to bail them out. Now, of course, if this was a true real market, this tiny bit of supply would be taken out in 2 seconds. I mean, what trader wouldn't smell blood? What sovereign nation, the Russians, some of the Arabs that hate us, wouldn't take out this measly amount? But in time, it'll happen. As for now, more and more people see that there's so little inventory out there and so much potential demand that it only, makes it more likely that the end of the COMEX's reign of terror is sooner rather than later.
Yeah, and we've been talking about the Comex default for a very long time, and we knew it wouldn't just happen in a conventional way. We knew that the government would do everything in its power to help cover up a Comex default. And Avery goes on to say in this article, that same day, J.P. Morgan transferred 177,402 troy ounces of gold into Comex registered gold stockpiles, which was just enough to cover the shortfall at maturity, plus a little extra to cover additional buying. All of which raises a question. Did J.P. Morgan just engage in a bailout similar to John Pierpont Morgan's 1907 bailout of the New York City banks? And speaking of a new friend to the cause, Andy, he says, if conspiracy theorists like those at GATA are correct, and I think they are, the worst case scenario would be a stealth government bailout. It's obvious to us both, Andy, that the world is waking up to the fact that the emperor has no clothes. And you're right, I think the vultures are circling. They smell blood.
Yeah, well, I'll say one thing. Stuff like the conspiracy theorists like Gada, that angers me. I take great exception to it, not just because I wrote for them and know them, but what makes Gada and the Miles Franklin blog, for that matter, so good is because it doesn't speak of conspiracy. It speaks of fact. I've been doing for 13 years researching and writing proof of the manipulation, as Gad has. There's nothing conspiratorial about it. What's conspiratorial is the propaganda that tries to paint it that way. Us tinfoil hat people as gold bugs, because God forbid we want to preserve our value while the central banks of the world are right in front of our face, printing money like it's growing on trees. But yes, that aside, the facts that he's stating, look, that all the numbers that come out of Comex aren't necessarily true. I mean, they even disclaim it themselves. But the fact is, if their goal is to suppress the price, which of course it is, the last thing they would do would be showing that they have very little inventory and that the amount of paper claims on it is more than they have. So clearly, where there's smoke, there's fire. And, again, whether it's because of one massive default, we have a crisis, or maybe no crisis, maybe the Chinese say, we've had enough, we're going to take it out. Or maybe it's just rendered irrelevant. Maybe something happens that the shift in gold trading to the Shanghai exchange becomes more pronounced over time. And eventually we'll wake up here in New York and we'll see the price movement of the day has already happened, as opposed to now where we wake up to see it happen.
Well, I just think that the liars are being exposed, and the whole world sees it. I know that our sheeple people, friends, neighbors, and colleagues still don't, which is astounding to those of us who follow the truth and are busy reading truth in truth media and alternative news websites like SGT Report and what you guys are doing at Miles Franklin there with the blog on a daily basis. But, it's my friend Mike Rivero who wrote today, "Of the liars, by the liars, and for the liars." And he says, let's start with some basic concepts. You live in an age of lies. Every day of your life, you are literally being drowned in lies. Lies by government, lies by advertisers, lies by the corporate media. Truth has become a valuable commodity. And that's what we're dealing in, Andy. You and I are dealing in the commodity of truth. And it's a rare commodity in a world of universal deceit. And one of the things on my notes list here for you is to talk about the two co-CEOs at Deutsche Bank who really shockingly and surprisingly resigned over this last weekend. What did you make of that, and do you think their resignation is tied to a derivatives bomb that is now in the process of imploding?
Well, I mentioned that this morning, and I try to tread carefully on these things because this is where the border between fact and conspiracy gets, a little blurry, because just because they resigned, it doesn't necessarily mean that something cataclysmic for the world, not for Deutsche Bank, is going on behind the scenes. That said, it's very, very difficult not to speculate on the fact that we've had this huge global surge in interest rates, completely unexpected, in the face of massive QE programs in the ECB and Japan and all these places, and ZERP and NERP. The fact that rates are exploding with economies and commodities going down is very, very terrifyingly unexpected to the powers that be. And when you see that Deutsche Bank, which happens to be the biggest purveyor of derivatives in the world right now, just as those interest rates surge, their CEOs resign and the company's being investigated, it's pretty hard not to speculate that something is going on behind the scenes. For all those reasons, Deutsche Bank has been the most horribly performing stock in the banking sector for years. So it can't come as a surprise to anyone that their management is under fire. But it's something to be watched, because those derivatives haven't gone away. If anything, they're larger than they used to be back in 2008. The only difference is that the powers that be have realized it's smarter to hide them and not talk about them, as opposed to way back when they talked about, oh my God, look at all the derivatives, they're going to be a default, everything's going to go under. Or, for instance, when the banks needed to be bailed out, they would say, oh my God, we have to go to Congress and get TARP passed. Now they just go, well, we'll just do it behind the scenes. Why do we have to tell anyone? Why do we have to, manipulate markets, in the open when we could do it secretly? It's just much easier. It keeps people from speculating.
Well, Andy, as listeners know, Deutsche Bank's derivatives portfolio is second only in size to J.P. Morgan's. And, of course, J.P. Morgan's backstop for their criminality is the Fed, whereas I think, and correct me if I'm wrong, Deutsche Bank's backstop is the Fed and the German government. And I say the Fed because, as we know, the limited audit of the Federal Reserve recently revealed something in the nature of $16 trillion going to foreign banks and corporations. It's just the height of fascism, and these governments are going to do everything they can to try to prevent a meltdown. But at the end of the day, there's not enough paper fiat on the planet to prevent the meltdown. Again, we're documenting the collapse, and the derivatives market is the place to look. The other place to look for the meltdown and evidence of the meltdown are the debt markets, the volatility. You say interest rates are rising in the face of all this. Let's talk about the debt market volatility. What are you seeing in the debt markets? Anything to cause you major concern?
Well, I mean, first off, when we talk about Deutsche Bank, I mean, yes, they are the JP Morgan of Europe. I mean, I'm not even sure the exact size, if they're bigger than JP Morgan or smaller. But, they're probably in the ballpark. And on that side of the pond, they are the government's main policy tool, as JP Morgan is here. They're all in it together. And I don't mean all the banks of the world, but certainly this kind of Western cabal that involves, the Fed and the Bank of England and the ECB. These are their major tools to get things done. And as for the debt markets, as I was saying, we've seen an explosion of interest rates in the last 6 weeks. I did an article or a podcast, I think it was 6 weeks ago, called Tectonic Market Shifts Portend Disaster, about how rates, despite all the QE and the falling economies, have suddenly surged. And it's very unsettling for a world that has the largest amount of debt ever, which is only growing parabolically at this point. And so, debt will destroy everything. So the last thing that anyone wants is interest rates to go up, which is why, by the way, the Fed has never raised rates despite talking about it for all these years, because they can't. They can't raise rates. Are you insane? They have trillions of dollars of debt. Their own balance sheet is $4.5 trillion of high duration bonds. If you raise interest rates, they destroy themselves. So no, this interest rate growth is slightly happening against the plan of keeping rates at lower negative rates around the world, and it's going to wreak havoc on record high stock prices and record high bond prices and record high real estate prices in certain areas, not all areas, and of course on sovereign debt and national and municipal debt and corporate debt and institutional debt and individual debt, which are all sitting at or near all-time highs as well. So again, all you have to do is watch that U.S. 10-year bond and realize that the higher rates go, the more global destruction it's going to cause. And of course, the reaction of the central banks will be to print more money and try to buy more bonds and push rates down.
Yeah, well, you know what? I think that there's a lot of fear behind the scenes because, as you just rightly noted, this is all going against the playbook. The banks and the governments need to keep interest rates at zero or below zero. And we know that they collude to do it because of the LIBOR manipulation. And they need to keep these zero interest rates to prevent the explosion or the implosion of derivatives and the paper Ponzi from beginning. And my friend Dave Kranzler over at Investment Research Dynamics wrote just the other day, a derivatives bomb exploded within the last 2 weeks, and he goes on to document some very, very frightening stuff. And I just want to read you this quote. I've never seen so many sophisticated Wall Streeters this scared in my entire career. That comes from a very well-connected Wall Street DC insider. And it makes sense because if these interest rates spiral out of control higher, against the playbook of zero interest rates, this will be an unstoppable collapse. And again, we document the collapse every 3 weeks so that people with the eyes to see and the ears to hear can understand what's happening behind the scenes. Because the mainstream mockingbird media, Andy, is never going to report these facts. They're not going to wake the sheeple from their slumber. When this house of cards comes down, there's going to be a hell of a lot of people in this country wondering what the heck just happened.
Yeah, well, again, I mean, the beauty of this is there's nothing they could do to hide what's going on now. Sure, they can try to hide their derivatives exposure, but they can't hide the fact that interest rates are rising and decidedly against the grain. In fact, just from an event-driven standpoint, I see it's, right now it's about 12:20 Eastern Standard Time. At 1 o'clock is the next Treasury 10-year Treasury auction. And I'm extremely excited, or I'm not excited, but I'm extremely interested as to see what happens, because there's no doubt that, because the government basically puts out all the numbers, they pretend it's a good auction or a bad auction to see what happens. Because if they can't make it into a, quote, good auction, which theoretically means everyone wants to buy bonds and rates are too high, and it goes the other way and rates spike through that key level of 250, because we're at 2.48 right now, I mean, it could, that's where there's giant stops out there, those round numbers. And they're not just at 2.8, they're at 1.0% for the German Bund, which is just about where it is right now. 0.5% for the Japanese JGB 10-year. I mean, there's a lot of trading money on the sidelines watching to see if these numbers break. And again, I mean, I think back to when I wrote an article about, God, a year and a half ago called 3.0%, enough said, saying the U.S. government was clearly doing everything in their power to prevent the 10-year yield from going over 3% because of the things we're talking about between the debt and the derivatives. And, you break through 250, you're going to be looking up at 3% again. That's a gigantic increase in interest rates to go from 1.6 early this year to 3% now. You're talking about the housing market, the stock market, the bond market, the derivatives market, all these debts, all these markets that are dependent on record low interest rates. And I'm talking about record multi-century low interest rates. And if without those, the whole game comes apart. There's just no way of hiding it. Remember, the U.S. government has 18 trillion of debt, and because of the wisdom of them moving it to short term, basically getting rid of a lot of the long term debt, they're as exposed to rolling over risk, or as they call it, duration risk, of as they've ever been. So the slightest increase in interest rates causes the deficit to explode. I mean, every 1% on an $18 trillion debt is $180 billion a year of debt service. And that's just the part that you see. So again, we're talking about all you have to do is watch that 10-year interest rate, because it'll be the death knell of the world if they can't get it to go down.
Absolutely, Andy. And the reason that I wanted to start with that article from Avery Goodman, did Comex just receive a physical gold bailout from the feds, is because we want to break some news here. We want to document the collapse in a way that's effective and in real time. And what's going on with JP Morgan and the Comex is real time documenting the collapse data. And the point is this, Andy, when the house of cards collapses, it is going to be just awful for everybody in this country, you and I alike, even those of us who have physical precious metals, to try to protect ourselves from the ultimate collapse of the fiat dollar. We're going to get hurt too, because the goal of these banksters is to devastate sovereign nations and to enslave them to unrepayable debt. And you need look no further than the Greek economy, which, according to Zero Hedge, is in a doomsday tailspin. 59 businesses, 613 jobs lost every day, and suppliers demand cash up front. This is what happens when you destroy a nation and you destroy an economy and you enslave yourself to banker debt. And I think that's what's coming for us, Andy. Unless there's some rebellion or revolution, unless there's some reset, unless there's some debt jubilee, I think we are headed down the same path that the people of Greece find themselves on.
Well, the majority of Americans already are. There's, a record low amount of savings and a record high amount of people on entitlements and people who don't have the ability to make ends meet. So yes, the debt enslavement, or serfdom as you call it, is, it's part and parcel of the Ponzi scheme. I mean, the Ponzi scheme, they print more money, it benefits the 1% at the top, and everyone else gets deeper and deeper into this. And then, of course, you have the secular changes, which have nothing to do with it, like all the jobs going to points east, which makes it even more difficult to make ends meet because there's less opportunities to do so. So yes, of course there'll have to be a debt jubilee, whether it's by by default or by hyperinflation, because this is unsustainable. But more importantly, it's growing parabolically. I mean, we're talking about Greece, where stocks are up today on the 500th rumor of a Greek deal, as if a Greek deal would be good, or why anyone would believe there'd be a Greek deal, because the new people in charge of Greece were put in place to not do a deal. But let's say they do. I mean, Greece had a debt to GDP of 140% back in 2011 when we had the last Greek crisis and they got their bailout, their 110 billion euro bailout. Well, now it's 180%. And if they get this new bailout that everyone's so excited about, or the markets are excited about, it'll be over 200%. Why would anyone think that that's going to help Greece? All of that money, if they get it, would go directly to the banks so that they don't close their doors, and directly to the government so it can pay back the very people that are lending it. And of course, it'd be those austerity measures that come with it, which they say that they're not going to take. I mean, it's pure madness. That's what I wrote about today. And whether they get this new bailout by the end of June when it's the deadline or not, it's not going to be perceived as good. It's not going to help interest rates to go down. If anything, it's going to cause upward pressure on the rates because it knows that the parabolic debt spiral is only getting worse. I mean, that would be the death knell of all the bailout system if they actually gave the bailout to Greece. No one would be happy about it, and no one would benefit from it.
Well, you hit the nail on the head there, and I love your quote. It's the quote of the day. It's pure madness, and it really is. And that's why we have these conversations, to document the pure madness and to document the collapse. Andy, what's the situation over there at Miles Franklin? You guys got an online presence coming soon, and tell people how they can protect themselves.
Yeah, well, for one, I was just telling someone before, while not a crazy increase, we've certainly seen an increase in demand in recent months, which is encouraging. And as for what's going on at Miles Franklin, it's very exciting. Yes, we will have a new website. We will have, we'll have online purchasing presence. I'm guessing sometime this summer, probably sooner rather than later. And we also have some other things that we're going to be talking about that we're very excited about in the coming weeks. And, again, I encourage you, not just a matter of buying gold and silver, but, listen to the podcast I did with Andy Sheckman a few weeks ago called Swaps, Trades, and Repatriations, where we show, people who have gold and silver already a lot of different ways that they can optimize their portfolio at very low cost. You can always call us at 800-822-8080 or email me at ahoffman@milesfranklin.com.
Well, very good, guys. Thanks for tuning in. You know how much we appreciate you guys tuning in, liking, and sharing this information with others. It's not too late to wake up our sheeple friends and neighbors and colleagues. It's almost too late, but it's not too late yet. So please do spread this information within your sphere of influence, and I thank you ahead of time for having done so. And Andy, I thank you for joining us today.
Always a pleasure, as I said.
Always a pleasure, Andy. And guys, thanks for supporting us at sgtreport.com and thelibertymill.com. Real news 24/7. God bless.